Hey, what's going on, guys? It's your boy Freddy. Welcome back to the channel. Today I want to go over 3 Canadian dividend stocks that I believe are good buys right now for long-term investors. Unlike our American counterparts, here in Canada we are more limited in the type of investments that we can make. Although we can of course invest in these US companies, we all know that the currency exchange is pretty brutal right now. There are of course benefits to investing in either side of the border, with US companies geared more towards growth and high price to earnings ratios, while Canadian companies do have slower growth, but they make up for that with their high dividend yields. It is these Canadian dividends that I'm chasing in my long-term portfolio, as the concept of living off dividends while not even touching the principal and letting it grow and grow is extremely intriguing to me. So today I want to go over 3 Canadian dividend companies that I'm looking to either add to the portfolio, or if the position is already in the portfolio, I'm going to be looking to add more heavily. I recently made an update video on the portfolio, but basically my goal is to create a dividend growth portfolio on Wealthsimple where I can add money to it consistently and easily through dollar cost averaging, where basically I put money in on a consistent basis and reap the rewards in the years to come. I'm hoping to continuously and consistently add to the portfolio over the coming years, with the ultimate goal to eventually retire off the dividends. And if you guys are looking for a more in-depth video on the portfolio, I will leave a link to that in the description down below. The first company that I want to go over is Telus, ticker symbol T.To. This is a telecommunication giant here in Canada and is my personal favorite out of the 3 companies that own the majority of the market. Their main revenue sources include mobile services, internet, residential services like TV and home phone subscriptions, and security. The company has 16 million subscriber connections with 9 million mobile phone subscriptions and 700,000 security subscribers. The telecommunication industry as a whole has a very high barrier to entry, as the cost to set up a communication infrastructure is astronomically high, and the companies who do attempt to get into the space are quickly bought out by one of the 3 big names, including Rogers, Bell, and Telus. Their security business is very interesting to me, as it helps to create an ecosystem between all of your various connections and devices. Instead of having to involve a third-party company to come in and set up your security system, you can conveniently hit up Telus and have them install and sync everything to your device at a cheaper cost. Their revenue grew at a very solid 5.5% in a year, where the telecommunication industry as a whole saw an estimated 2% decline. They added over $300 million in cash to help them through the illness, and overall are in an extremely solid financial position. Some of you may have heard the news that Rogers, a big competitor to Telus, made a deal to purchase Shaw, which is a big communication provider in Western Canada, for a whopping $26 billion. It is definitely possible that this could be seen as a negative for Telus, as the competition is merging to form a massive company that will overtake Telus as the second largest telecommunication provider. But how I see it is that regardless, that competition was already there. Before, it was competition with 2 separate companies, and now it's with one larger company, but the competition itself hasn't really changed. Telus recently announced a massive share offering for over $1 billion to increase and expedite their 5G infrastructure. This is an amazing move to me, as the stock dropped hard on this news, which means that as a long-term investor who sees himself invested in this company for decades to come, this is an opportunity to buy the company on a nice dip. And also, the company is now growing and reinvesting back into itself to become a better communication provider for its current customers and potential new customers. The next company that I'm watching is RioCan, ticker symbol REI-UN.TO. This is a commercial real estate investment trust and is overall the 2nd largest REIT in all of Canada. They own 221 properties across the country, including office and residential space, and have more than 16 properties currently in the works. They have some major projects currently in development, like the Well in Toronto, which will add another 1 million square feet of space and will offer both retail and residential space. Another big project is 5th and 3rd East Village in Calgary, with 178,000 square feet of commercial space and many other properties in the works. Even through such a terrible economic downturn, RioCan was able to collect 94% of rents and have an occupancy rate of 95.7% for the year of 2020. This is absolutely phenomenal, and I was honestly really surprised and impressed that they were able to have numbers like this, given that a major portion of their revenue comes from retail stores that were shut down for months on end. One really sweet stat that I saw was that the average population within 5 kilometers from a RioCan property is 200,000 people that have an average household income of $117,000. This shows that they are buying and building properties in high quality locations with clients that have the funds to live in and shop at their various properties. Looking at their tenant mix, we can see that over 28% of their revenue comes from grocery stores and essential personal services. They also cut properties in apparel and movie theaters, which was obviously a very smart move given the current health situation with the illness. Revenue for 2020 was just 0.3% less than 2019, which blows my mind considering everything that transpired. Operating income was down 9.1% because of rent relief and various debt that they had to tack on, and they increased their development by 4%, which is great as it shows that they are continuing to push forward and expand their business and are not yet satisfied. The company is mainly centralized in GTA, where 47% of their properties are located, with the rest dispersed through the major cities in Canada. Personally, I am fine with this split as the Toronto market offers so much potential for appreciation, and if they're able to consolidate a major portion of the commercial real estate industry there, I see that as a major win. When REITs are properly managed, they can be very profitable businesses, and RioCan is no exception, showing $680 million in operating income on $1.09 billion in revenue. RioCan is still about 30% down from its pre-illness levels, and given the clarity that the report provided, I see this as a company that I'm definitely interested in investing in. Although it may not look like it now, I believe that there is light at the end of the tunnel in terms of the illness as vaccine distribution continues to roll out, and with summer on the way, people may be looking to get out and shop again, and RioCan will very much benefit from a return to normal. The last company that I want to go over is Bank of Nova Scotia, ticker symbol BNS.TO. This is a Canadian bank stock and is a fundamentally solid company. They differ from the other major banks like RBC and TD as they have invested heavily into establishing their business in emerging markets like South America. They're the 5th largest bank in Mexico, 3rd largest in Peru, 4th largest in Chile, and 6th largest in Colombia. As these countries continue to develop and transition, Bank of Nova Scotia will have already established themselves as a go-to name and really have a leg up on the other banks. Their push into emerging markets, along with their solid revenue and dividend growth, have made this company my 2nd largest position within the portfolio. They have continuously paid a dividend since 1833, and it is still growing at around 5% over the last 5 years. This is a stock you can confidently add money to and consistently grow your position very quickly by reinvesting the dividends. Personally, I have slowed down on adding to Bank of Nova Scotia over the last couple months as the stock has been on an absolute tear since its dip from last March. Currently, I'm waiting for a bit of a pullback before I continue to add heavily. Net income is down about 20% since last year, and although the overall company is still very solid, it is a bit beaten down due to the illness. I'm hoping that as earnings come out over the first quarter of 2021, people will realize that the company is valued a bit too high for the current performance and we see a bit of a pullback. Regardless of if this dip happens, I will continue to dollar cost average, but will add more heavily if it does occur. Well, that is my list of the 3 Canadian dividend stocks that I'm watching in April of 2021. Let me know what you guys have on your watch list in the comments down below. Also remember to leave a like if you enjoyed and consider subscribing for more investing videos like this to come. I also have a Watson referral link in the description that gives you $10 when you deposit and trade with 100 or more. So if you're looking to get an instant 10% return on your money, make sure to check that out. I'll catch you guys in the next one.